Welcome to another episode of the Tour on Air podcast. Today I'm joined by Kendrick Nguyen, the founder and CEO of Republic.
Niko, thank you so much for having me today.
I'm really thrilled to talk to you because whatever you want to call it, retail revolution, evolution, disruption of Wall Street, decentralization of finance. I mean, all these topics are really dear to my heart. So I'm very excited to be speaking to you today.
Yeah, no, I think we're just at the beginning of what's going to be a global adoption over the next few years and possibly over this decade. So just thrilled and what a privilege to get to speak with you and share and trade perspectives.
Thank you so much. So before we get into kind of the macro aspects of it, the future outlook, the target audiences, the trends that you see, just to give us a better frame of understanding where you are operating in that space with Republic. Give us some data points maybe around what Republic has achieved already, and what your secret sauce is, and who you're going after.
Yeah, absolutely. So first of all, we're based out of the US. That's our headquarters. That's our main operation right now, but we obviously have global ambition. We are an investment platform that people come to invest in things they're passionate about, whether it's in early stage companies or SpaceX or Robinhood, whether it's residential real estate or crypto technologies, and soon music financing, movie financing, just anything can be an investable asset. We have to date in the past 5 years deployed over $400 million out of a community of over 1 million members strong. And the focus on our side, even though our biggest vertical indeed is tech companies from early stage to late stage, we have a wide range of assets. In fact, we're the only multi-asset private investment platform currently in the US, as far as I know.
Yeah, I saw that. I mean, also that you have sort of buildings being financed. I thought that was really interesting on the real estate side. Like what's the, if you say early stage to late stage, sort of startups being the main part of the platform, how much do the other asset types represent roughly?
The other asset type, I would say, in 2021 will come to represent at least 30% of the total capital deployed. Noted that they are newer. We started out 5 years ago with tech investing, and only fairly recently, within the past year, added on real estate and a few other verticals. But because the infrastructure play and the adoption rate gets faster and faster, so newer asset classes gain more traction in a shorter period of time compared to the 2016, 2017 vintage years.
And I guess like you must have gone through the typical chicken and egg problem, right, of any marketplace out there. There must be a tough one, like how to get the first clients with not having maybe enough investors on the platform, and vice versa. How did you go about it? What worked well for you?
You mentioned a two-sided marketplace, and added on it being a heavily regulated space is a phenomenally difficult business to build. But tackling two sides of the market at the same time, just like you mentioned, Nico, is the only way to go about building it. But through just hustling, taking every meeting, every call, and relying on, quite frankly, just team members with expertise in branding and marketing, so that we can acquire can acquire community members. We rely on partners like AngelList and Techstars for the deal flow, and we relied on advisor for validation signals as an early stage company to give companies credibility, the confidence they should come and work with us. So it was a Herculean task in the first couple of years, and things have gotten easier, but we're in such early stage of what is going to be, I believe, a multi-trillion-dollar industry. So it's still going to be major challenges ahead. But I can't imagine that any year would be more difficult than the first year and the second year of launching the business that is Republic today.
And were there for you sort of, in the, let's say, growth marketing in the early years? Were there like a few things that worked particularly well that you were maybe even surprised to see work better than other things?
As it turns out, investors, retail investors, and inexperienced investors tend to invest when they follow someone who's a guru, a celebrity that they know, or like a company that they already have attachments to. So what had worked really well is if we manage to convince a company that already has a big user base, a big customer base, and those customers want to be an investor, want to have skin in the game, that's by far is the most efficient way to both acquire new users, but also a lot of actual investor right at the outset. And the second one I would say is being able to convey that relatability, the human face behind a company and behind Republic through social media, rather than just giving, spitting out numbers about returns or whatnot. Explain why we do what we do. People 9 seconds a day or 9 seconds for attention span are able to relate more quickly with stories and with people than they are with numbers.
And is that like something that you saw also? I mean, that companies, like the reason for companies to join and use this as a route of financing, I wonder, whether the reasons have changed and how much still, for companies is the idea of having maybe a participation of their users in the upside of the company. So having it more like a, maybe marketing or, user retention, community outreach type of effort, rather than really being dependent or choosing this as the right source of, investor relations or investor acquisition.
Well, capital in many cases is cheap. The question usually is what value comes with that particular type of capital. So in our case, retail capital comes with what had you just described, that customer engagement and marketing value, such a powerful and unprecedented value, because once a customer becomes an investor, she's gonna be so loyal to the company. She's going to be the company's biggest ambassador. So that value, they cannot get anywhere else. It's not like they can run marketing ads and you can get people to buy things. But imagine your 1,000 most passionate customers now are out there talking relentlessly. So I think that duality you're going to see continue. And it's truly not one versus the other, but capital has value and so does the marketing value. Now, as we grow and as the industry continues to grow, you're going to see more mature companies come to us to engage with their customer base. Before, they might have thought that, this is not worth the effort, it's too new. Now, I think the customers are going to expect that they have the ability to invest. And so it's probably going to be organically driven by the customers rather than us having to do that sales pitch. So that's probably is going to be that shift over time toward more and more larger established companies with major communities organically reaching out to do this via Republic.
And I remember in Germany, I don't know if you had tabs on these companies. There were seed stars. There were a few kind of seed companies. You would call them a seed crowdfunding investment company, and I'm sure many of them still exist. But it didn't show like tremendous growth. And that was maybe 5 to 8 years ago. There was this phase where the Kickstarter model kind of merged into a crowdfunding model where there was also equity participation for the people that would fund these typically new ideas, so less existing businesses. Do you have an explanation, or have you seen a similar pattern in the US for these type of companies, and why now Republic seems to really be having kind of solved the puzzle, or being there at the right time and right place for this to really take off the way it does at the moment?
Well, if you look at the venture capital system, and in the US, the largest venture ecosystem, it's been around for just about 50 or 60 years. So there's no reason, it's not rational to expect that that's the best model. Of course, it's the first model and it's going to evolve over time.
Mhm.
But anything is going to take a little bit of time to gain this adoption. You mentioned about the German market for retail investing, seeing slow growth in the early years. In the first year of Republic, we facilitated $1 million total. And in year two, we did like $4 million total. Now in year five, toward the end of year five, in 1 month on the retail side, we did more than $50 million in just a month. So it's the variance or the growth is a snowballing effect in any market, in any industry. So I don't think it's unique to, I know that it's not unique to Germany. I know that the growth trajectory has been similarly long in the US and in the UK and in other markets as well.
And you don't think, or I wonder how you solve that issue. Maybe this is also something that by country just differs in terms of legislation. The kind of, the rights, excuse me that I don't know the exact legal terminology here for US based companies, but, the kind of like information rights, the rights that individual investors then have in asking for information. Is that not a deterrent, or is that being solved in a different way via technology or also legislation, that I, as a founder who may choose to go this route of raising funding via Republic, don't have to worry about having 500 investors try to contact me over email with questions?
Those are very legitimate concerns that some founders may have. I've always said that fintech and what we do at Republic is half of it is legal tech, because knowing how to fix this issue with legal mechanics through contractual rights, through regulatory advocacy and changes is part of the game, part of playing in this sandbox, and that's something that we're fortunate to be able to do. The regulatory pragmatism and expertise at Republic internally is not less than some of the largest law firms in terms of our experience. And so we worked in the US with the SEC, with state regulators. We work with a dozen outside law firms and use them to provide feedback on products that we come up with and produce legally in-house. So I would say that in that construct, the ability to fine tune and create new legal products that deliver and address the cases that you mentioned and many more is important, or has proved to be valuable for us. And that's something that we continue to do. But at the end of the day, Niko, someone who invested $20 into a beer brand, a vodka brand that she really loves, may not care about having to cast vote when there's a corporate decision. It's just a psychological notion that, hey, if this company is going to get bought out for $10 billion, I want to have a 10x, a 50x return on my $20 and my $200. Like, most people don't want to be that involved. They want to care, they want to evangelize, but the concern about investor rights and voting rights for someone who deploy $500,000, they're just not the same, or they're just not something that a micro investors care about or even want to be bothered with. And so these are things that we learn and over time, and how to deliver a product that meets investors and founders' expectation will always be something to improve over time.
So you mentioned micro investor as a term, and you gave us some data points now of $20, $200. Like, what's the average, or what are some of the numbers you can share here? What's the mean the median on the type of investments that your users are doing in these type of companies? And is there an upper limit also to what people can actually invest?
There used to be an upper limit on how much people can invest as a virtue of law, but that law has changed. And so now, if you're a very wealthy investor, there's no limit on how much you can invest legally. A company, because they may want to have 10,000 people in the round for marketing purposes, and that's only $1 million offering, so they have to limit the amount that one can invest. But legally, there isn't really that cap for those who are accredited. For those who are not, there is a limit based on net worth and income and all of that. But the average investment on the Republic retail platform is just about $500. But some deals, people are investing $20, and in some cases, even $10. So one of the core component of the technology here is, how do you facilitate a $20 investment, go through KYC, AML, record keeping, everything else, and the fee for that transaction still is sensible enough to make it doable? So to give you an example, let's say right now you are in, say, where are you today? Berlin or?
I'm in New York, but generally Berlin.
Yes. Let's say, assume that you're in Berlin right now rather than in New York, and you want to make an investment in the traditional sense and buy $20, something for me. Just the bank processing fee across the Atlantic is probably already $10 at least. Rendering a $20 investment not feasible. We have reduced the fee so low, and we're still going to reduce it further through leveraging blockchain technology, so that one day a single mom from Malaysia can invest $2 in a restaurant in Berlin or a startup in Silicon Valley. That, I think, is the ultimate goal that we still have a little bit of a way in getting to.
Blockchain was definitely on my list of topics to talk about, and we may get back to it. But now that you mentioned it already, so in that example, like, how does blockchain for you facilitate, these type of transactions and lead to a more cost-efficient cost structure?
It's already, whether it's Dogecoin or Bitcoin or Ethereum, obviously Bitcoin and Ethereum being the two most mainstream acceptable cryptocurrency, with vastly lower payment processing fees compared to traditional fiat, whether it's the euro or the US dollar or the British pound. So that has already made it so much simpler. But there's two other attributes, which is the ability to fractionalize anything down to small components, and the ability to automate cheaply things like KYC, AML, record keeping, that I think will open the door wide open to virtually everyone and enable them to invest and transact privately. 5 years ago, a private investment or a private transaction less than $10,000 or $20,000, it just doesn't make sense, because the fee and the time and the cost is too high. Now, pre-blockchain, $500, $100, $20 makes sense. I think we clearly are heading full steam to a future whereby a dollar investment, 50 cents, quickly, speedily will make sense. And that's how you get everyone around the world to participate.
And are you in one of the camps on which technology will achieve that? Are you, I guess agnostic, but what are you betting on? Because you have the Bitcoin maximalists who will tell you that all of this will be done on Bitcoin, and Lightning will solve issues of scalability. On the Ethereum side, you have similar arguments. I mean, the gas fees at the moment are actually very high, right? For these type of, or at least my type of transactions I do with Ethereum. What needs to happen for that reality to really come true, and what's the time horizon that you, as a founder now of a company that wants to use that technology, kind of calculate with or expect?
It's a hard question, and I'm gonna try to answer that completely with an open book. So you mentioned high gas fee, but that's comparative to one another within the crypto world, but there's no question that it's nothing in comparison to the $50 processing fee for me to send $100 to Vietnam. So gas fee is still today already much lower than traditional world's payment processing fees. Between Bitcoin and Ethereum being the two largest one, but there are other rising and competing. Dogecoin, think what people may about it. I personally very much are firm believers in three main aspects. I think Bitcoin and Ethereum, because they're two of the most established, Bitcoin being, the oldest one, naturally, have that advantage and likely is here to last. I think the word of tokenized securities or layer one that can facilitate securities functionalities, I think that's going to have tremendous impact. And in the US, you have Algorand, you have Avalanche, I think Binance Smart Chain recently launched. So my bet is on those chains getting commoditized over time. And it's depending on which one can build a more robust ecosystem. There can be more than one ecosystems in different countries and continents, and there's room for a lot. But I wouldn't, for investment purposes, just pick one thing, particularly those who are new to it. I think it's betting on the technology and know that this is going to fundamentally change our future. So imagine if you have the chance to back the internet or back search engines in the 90s. Are you going to pick Netscape, Linux, Yahoo, Google? Well, if you have the ability to, and now you do, to have a little bit of it in all of these and know that maybe 80% will lose and the two that manage to survive will yield you return in excess of that which you have lost. So that kind of like casting a wide net and betting on sector, programmatically and broadly, rather than selecting and picking one winning horse in a race that is still very early on with strong contenders, but with a lot of unknowns that difficult for anyone, certainly for me, to speculate.
And what at this moment does Republic use in terms of blockchain technology? And is there something already on the horizon for us to look forward to? Because, in essence, asset tokenization, also for real estate projects or something would be, incredible to see. But at least when I scanned the website, I haven't seen that yet on Republic, correct?
Yeah. So Republic has our own token. It's called the Republic Note. It's republic.co/NOTE. Our Note token is a profit sharing token, and it's going to be launched on the Algorand chain. Now, there likely will be a wrap token on Binance Smart Chain as well. But again, as I mentioned, the securities enable networks, there are options out there, and we also collaborate very closely with Avalanche, AVAX, as well as Polkadot, and also we're close to the Huobi network as well. So at the end of the day, the first iteration of this on Republic for ourselves is going to be done on Algo and Algorand, but that's just the first of many that you're going to see rolled out. And Niko, you touched on a great point, not just about Republic, but about the industry in general. There have been a lot of promises about tokenized assets, but no one has seen like a major case. The reality is not until about the last 12 months that technology and regulatory evolution now make these things doable at a larger scale. Without it being at a larger scale, you can't have real adoption. But hopefully, I'm hoping, and Republic is going to play a role in driving this, that by the end of the year, there's going to be the first true security token that everyone knows about and most people around the world can buy, even if they are non-accredited. That today does not exist just yet.
And what field do you think will that be? What do you think will be the industry or investment class that will adopt this first?
I am gonna guess that it will be a growth stage company or larger that has a huge community and that's willing to share their revenue or their success, their economics with their community. So Facebook and Libra and that whole their regulatory saga is, was what it is, or it was. But imagine the Facebook of the world with a huge communities issuing tokens that also pay back
Yeah.
dividend to their token holders, how powerful that would be. I'm gonna guess that the one that you're gonna see would bear attributes of something like that.
And I mean, personally, I'd feel very passionate about, real estate, where I built one business in sort of the real estate world. And, it always like, knowing the possibilities, the theoretical possibilities here of asset tokenization, this, could really lead to a total disruption in the real estate world, right? Like the idea that I'm paying rent so that the landlord can, with my rent, service the debt, and also usually, have interest or margin on that payment, and then appreciate the asset appreciation over years, right? To kind of put that upside down and allow the people who live in the buildings actually, have that upside into the building, right? Like, yeah. When will we see that?
Yeah, absolutely. Now, if it's a small building, you really don't need blockchain technology or tokenization to achieve that purpose. We can facilitate it traditionally on Republic, but there are major real estate firms out there with many hundreds of thousands of renters and subleasors and all of these things that they can build and weave into what is not just an economic sharing engine, but a community engagement engine. And community means loyalty. Loyalty means action and monetization. So any company that desires building a community gotta take a very serious look at economic sharing, because again, people will come to expect that. I think long gone are the days that you're going to be the first drivers of Uber,
Yeah.
or the first lister on the next Airbnb and just sit passively and not gain anything, because they're going to be competitors who offer that incentive, and they're going to win out at the end of the day.
And you, just to summarize, like, to understand, you think that blockchain, ultimately makes that just cheaper, and thereby gives more people access to buy into such assets, because one can facilitate smaller payments, because you say that a lot of the other functionality is already on Republic today.
Cheaper, quicker, and with ease means more and more people are gonna get in, and more money will flow into the ecosystem. So engagement and that resources is kind of like rain to a desert. The entire field is going to be greener, and don't know which one is going to be a flower bush. You don't know which one's going to be a cactus, but I can tell you for sure that if there's rain coming to a desert, it's going to look a lot greener overall. That's the same view on how we look at unlocking $10 locked under hidden under someone's mattresses up in a small town in Vietnam or in Bali, and now enabling these people to funnel it into the global engine that is the economy, the financial system that we have today and tomorrow.
I'd love to see also the ease part, considering how, somewhat clunky it still is also to participate in existing blockchain
So
tokens.
clunky. Yeah, it's so much that Niko, I'm the last one of 5, big family, and my oldest siblings are way smarter, certainly more accomplished in that they're like doctors with PhD and all of these things. And just a few months ago at a family reunion, and most of them asked me, it's like, so we heard about Bitcoin, but how do we buy some? I'm like, have you not gone on Coinbase? You don't need a wallet. And they're like, we don't know. We heard something about just Ethereum wallet and all of these things, so we haven't yet. And I'm like, wow, in California, some of whom live in Silicon Valley, clearly have high IQ and yet have not made that leap just because the user experience, like you said, is
Absolutely.
so clunky, so janky.
Absolutely. And what do you think, like, when you look at your consumers and what you will expect also for this next kind of generation evolution of yeah, the global investment field? We're talking Gen X, right? At one point. And what do you see, this new group, because they're already playing with fractional shares, etc., on Robinhood and Cash App, etc. How do you learn about this new audience? What are some of the striking factors that you see?
I think the societal shift, and that is in many ways a generational shift as well, towards a bit of a freer sentiment. I would like to think that compared to our parents, we are freer in our mindset. And there's no question that my nieces and nephews, when they grow up, they're gonna be freer than I am right now. That freer mentality means they want to do things that more align with their true interests rather than doing things because they should. To give you an example, at one point, people won't see 4 years in college as a necessity that you have to do it even if you don't want to. Drop out, be a company, drop out, be a surfer. Similarly, I think my generation, and probably even, and most, certainly the generations before that, and even some in the current, the Gen Y or the millennials or Gen Z, investing for me was this boring thing that I should do to be a responsible human being. And the shift and the trend, the movement here is that I think the younger folks, those in high school or first in college, are beginning to say that, hey, if I love something, I should be able to look at that as a way to make money and build wealth out of it as well. It's not that I should go surfing and spend money and then like try to buy some mutual fund. There may be an antique surfboard collection that I can acquire and put my money in there and yield more in return. So I think that alignment of passion with potential profit is probably the biggest shift in this context that I observe in the new younger generation.
Totally agree. I see that also with my nieces starting out now. But I must say, when I look at it in a nuanced, differentiated way, I also do see kind of exuberance and, people are, very at ease with levering up their positions. And, I'm sure last week must have been very painful to a lot of young investors when margin calls set in. There seems to definitely, I don't know if you agree on this, but a high need for more education also. Because
For
I've
sure.
even spoken to some people that weren't even really, so knowledgeable about like how that actually works, when you're levered up and, a margin call sets in.
I agree entirely. Funnily enough, with a liquid market like the public markets or crypto, you have all of these risks associated with either uninformed or reckless trading activities. You don't really have that with private investing. It's harder to get mainstream adoption as well. But you're not going to invest in an early stage company and park your way with $1,000, and you can't leverage it, you can't sell it, you can't time it. So when it comes to things like crypto, I absolutely think that the only way is an education and disclosure. But more than that, if you allow people to participate with $5 and $10, there is no better way to learn than to just do it, but with the amount of money and the expectation that you may lose all of it. If you expect that people are going to read 5 books and then invest the first $50,000 in one swoop, no one is going to read, and a ton of people are going to lose all 50,000. So isn't the narrative one that's open door, but plays in their levers so that people can do things and learn sensibly rather than some sort of like a prohibitive approach that you are sophisticated enough because you have $1 million in the bank. Well, what if you ADA, a teacher of history, have never learned about crypto or investing and just save every dollars in the past 50 years? You get to $1 million, but you don't know anything about the market and you can lose all of them. So I really think it's got to be a different way in providing and showing people how to do things in an informed fashion rather than some arbitrary metric or parameters around sophistication.
And how do you see it in terms of, I mean, I'm sure, especially on Republic and also from what I've seen, the type of companies often very sort of, founder passion led companies, what is the take or regulation or framework that you use for maybe founders who don't want to sell their companies ever? And how are dividends or profit participation, how's that being handled?
Yeah, we so out of like 8,000 applications to launch on Republic in 2020, we launched less than 200 deals. So clearly a very significant curative lens. But that conversation, one, we won't onboard any company or any deal that we believe makes no sense fundamentally or has no promise, unless there's already a existing community that love them regardless. But to answer your question more pointedly, Niko, is this: if you're a company that has no ability to get an acquisition or going public at a very high valuation, whether because the founder doesn't want to sell ever, or because you're a restaurant, a single restaurant that sells food in a disadvantaged community, amazing food, good business, but you're going to be $1 million business and never going to be 100 millions, much less a billion. Those businesses got to have a different investment model. Maybe pay back 10% of your revenue until people realize 2x. So it's called revenue sharing or profit sharing, and not the venture binary all or nothing model. Real estate on Republic is an example. You're never gonna, very difficult for you to lose all of your money if you invest in a small piece of real estate. It's never gonna go to value, very rarely. You're never gonna make 10x either. You're gonna yield 12%, 13%, 14% return year after year, and that's more than plenty for those who love real estate. So one of the reasons why Republic is a multi-asset investment platform is due to the fact that people have different risk and return appetite, and people have different passions and interests. How do you align this whole two area? You got to deliver products of different types and let people choose for themselves. The question and the challenge still come back down to information, disclosure, and meeting the expectations.
And how do you vet the companies? You already said, some pointers you gave us already, but like, I'd love to, I'm sure you have, a lot of criteria set for the valuation. How much of it is also maybe qualitative, like talking to the founder? What are some of maybe the more surprising things that you would want to share around your vetting process that one may not think of, that you realized was actually very valuable for you?
So it depends on the asset class. So to give you an example, if you're going to invest in real estate, a piece of a house and a management firm, I mean, it doesn't really matter who owned that home, right? Whether the person is young, with or without a college degree, doesn't matter as much. There's still some relevancy there. For an early stage tech deals, it is the team and the resiliency and their track record and their integrity. The combination of these soft skill sets matters more than anything else in the early stage. Almost all companies gonna pivot. They're all gonna face incredible hardship and they're gonna ride it through. So it is surprising. I know that people matters, but when it comes to investing, people really, 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 really matters. But there's one lens that I typically look out for when I personally invest in a deal. And it's a hard one to read, but you got to learn how to read it, in my opinion, if you invest early on, which is, do the founders, and sometimes it's just a single one, have such a strong, unwielding passion, interest in what it is that she or he or they are building. That piece is easy enough to pick out because you can hear in a conversation or whatnot. And the second one is, how burdened are they life-wise? If someone is going through a divorce, or I'm sorry, if I can pick that up at the outset, it's probably gonna give me some doubt that he or she's gonna have the bandwidth to focus all in on business. May or may not be fair. It may be someone who's like incredible on that end. So I think the state of life and how free they are, it's not about actual obligations. Someone can have 5 kids and at the same time everything is going well, smoothly, everything is one bucket. But you can pick up whether someone is experiencing a very frictional experience of life in addition to this startup, or whether someone is in the flow and this one fits in, because this thing is going to take all the effort and the energy you have to deal with friction and challenges. There's not a whole lot of room to accommodate something else. So that read on where they sit in their Umwelt, I believe, is a German
That's
word
a good
for
one.
this,
Yeah.
is the key, I think.
That's interesting. I mean, it'd be interesting to see data on it. Like if the data supports your hunch there. I think, when you look at, for example, parents. I don't know if I saw actual data on it. I certainly saw data that women are the better founders when it comes to success rate. That was interesting, not surprising, but I think it's really good also to have that data to do that analysis. There were some reports in Germany surrounding that were really interesting. But what I find, for example, with parents often, if this like the processes necessary to manage one's household and the hobbies and the kids and all these things at home, like just in my group of friends, this is very qualitative research, right? So nothing we can extrapolate from, but I think it often builds not only the resilience but really also like this process driven mindset that everything has to be somewhat process oriented for it to work at home. And they're often just incredibly mature as founders also, because they've learned so much in managing their household.
And perhaps they're not as distracted about being on Tinder and
Exactly.
going out to pick up on dates until 5 a.m.
Yep.
So it more than makes up for the time that they need to their family. So in those cases, that's why I think I
Yep.
base this read bay on how in the
Sure.
flow
Yep.
rather than how at ease, as
I think that's
opposed
yeah.
to how much free time one has, because how you define free time is very loose. But most people in a happy relationship, or people who are not looking to form
Yep.
new relationships, and happily so, frees up so much time.
That's a great point. Like I remember there's an entrepreneur called Martin Varsavsky, very accomplished serial entrepreneur. Lots of businesses. Also now has the largest chain of fertility clinics in the U.S. And he's been a speaker at our conference very often. My ex-boss, so good friend by now. And he once told me, he said, Niko, he has 6 kids, and he says, the moment I became a father, I started becoming successful at company building. And he said it was a lot to do just how he started to value his time, because he had less of it. So he had to really make the most of it. And he became just much more focused also in his work.
May
So
I
yeah.
ask, Niko, because you have, I'm sure, probably even more founders than I do, even though I've spent the past decade working for investment platforms, building investment platforms. Do you know how many of however you describe successful founders you have spoken with, of them, how many of them come off as happy human beings, like energetic,
Mhm.
happy?
That's a yeah, that's a very good question. So let's say, I wonder if I should answer it as a percentage or rather, compared to the other cohort of not founders, right? Is it a larger degree of people that are happy or lower degree? I would say it's a larger share, but I think it depends a little bit on the stage of the company. Also,
Of course.
I think there's always these phases where I see founders really struggle mentally. I mean, it's pretty much from valuation from fundraising to fundraise, right? I mean, it always seems to be like when you're not profitable, and in our world of high growth tech companies, right? In the early stages, companies basically need money or they will die. And I think that thought often becomes apparent to a founder only in those 3 to 6 months before closing the round. Because once you've closed it, you're back on the high of like, yeah, amazing. Like, oh, we just closed the round. Like, we are on track. Like, this is all going amazing. And then a year later, you're like, okay, we need money again.
Right.
But I would say, yeah, I mean, ultimately, what we do our tour also, we always, what we went after in terms of positioning our conference/festival. Some, described it as a South by Southwest of Europe, just to give you kind of an analogy, because we've always been interdisciplinary. So it was always about bridging between the technology world, but also the science, academia, the creative world, the arts, the music, and, politics, media. Ultimately, it's now the platform for everybody who's interested in technology. But I saw that kind of, common thread also between artists, musicians, and founders, often in this mentality of seeking self-actualization, right? Wanting that kind of last step on the Maslow hierarchy of need, and going after it, and that requires you to leave the safe harbor and sail out to the windy ocean, and God knows what's going to happen, and anything could happen, but you're choosing to do so. And often, I find also, yesterday or 2 days ago, I interviewed the founder of the largest voting systems company in the world.
Wow.
And he's also writing children's books and composing songs, and is an engineer. And like, there's often that kind of common kind of interest there, or passion for taking those risks. And I think often people are fulfilled by doing so. But
Yeah.
lastly, and then I'm interested in your answer, what I do say also often is, if people don't take enough time to build out meaningful relationships in their private life, to go after hobbies, to take care of their mental health, to eat well, etc. Often the most successful ones, the billion-dollar plus company founders, then I see them kind of crash and burn often, because their realization sets in. Okay, I have everything I need. Now I may notice that actually I don't need all of that. It doesn't necessarily make me more happy, but I kind of had a lot of opportunity cost along the way, because maybe for the last 10, 15, 20 years, I destroyed relationships. I did not look after my health, etc. So needs to be a balance. But what about you? What's your
Yeah, no, I agree. Your observations are so insightful, and I think I agree with pretty much all of them. Um, I think that everyone is more effective when they're happier, when they're feeling more pleasant. But how do you pick up in a couple conversation whether this person is just happy at that moment and may not have mental valleys, and whether the person is more anchored and really is overall generally positive and happy, thereby more effective with the same skill sets and attributions? That's a little bit harder to pick up, but I think that's quite Republic. Aside from the metrics on execution and performance, we place a huge, at least I do, a premium on positivity. Positive in intention, positive in expression, in how you resolve conflict and how you react to things. It's a hard thing as we grow as a company. But the question about, oddly enough, we pivot from your question on how we judge a team for investment purposes, but I think these kind of things
Yeah.
translate into all aspects of organization and human dynamics.
I love to pivot out. So speaking of pivot, if you have 5 more minutes,
Of course,
then
of
we
course.
just, you know,
Yes, absolutely.
we wrap it up with one or two more questions. But one more thing I now need to say about this, you probably know this formula for happiness, which is kind of expectations minus reality. You may have heard about this happiness formula, right? And I think, you know, that
Actually,
expectations. Oh
if you
yeah,
don't mind,
so happy.
clarify it for me a little bit.
So so
Yeah.
so happiness. So we did a talk also with a happiness researcher. He's the founder of the first happiness institute in Denmark, and he is the founder of the Happiness Museum, and he wrote a lot of books about happiness. And we did I'll send you the video after. We did a talk with him and then actually an investor, an impact investment investor. And we spoke about this like happiness formula, which is defined, and God knows who came up with it, but as happiness equals expectations minus reality. And, you know, that basically makes it all somewhat dependent on expectations, because the reality we're not really in control of, right? We can, you know, do our best to create a great reality for our companies, for our families, etc. But there's so many variables that are not in our control, but the expectations, we can work on that. And I think this is also where I see maybe the founders that are most happy are the ones that, sure, they want to go after, they want to build $1 billion company. They want to, like, you know, knock it out of the park. They're passionate about it. They're having fun. But if it doesn't happen, you know, their personal happiness is not too closely tied to it, you know? So keep the
I love it.
expectations low, basically. And, you know,
Yeah.
then you can only be happy with the outcome.
Or if you keep your expectations really low, you probably would be happy. But a way of looking at it and saying, you know, the same thing, I think in my case is that it's about the experience and the journey rather than the end result. Because
Yeah.
just like you said, reality, so much of it is outside of your control, but you are in perfect control on how you feel, how you choose to feel in a particular moment. And so that medium between reality being what they are, I have agency, and obviously I have huge personally the gratitude for this, how lucky I am to get to be building, to do doing this, as compared to so many things that, you know, in a different environment that I would need to do or would be in. So that gratitude and the appreciation for the presence, the moment and the journey, as opposed to chasing after some goals. And when you get there, you realize that the journey had just been not so great. And if you don't get there, then you have like a mental breakdown. At least those paths, I think, if we're intentional about it, hopefully are avoidable.
This would already be an incredible closing point, but I have two questions, if I may, that I ask everybody on the show. And one, actually, this time, you know, I'm very excited to hear the answer, because you've been talking about pivot 2-3 times. And the question is around, which I find often for founders to be one of the toughest questions to deal with in their founder journey, is around to pivot versus to iterate on the product, right? We all know the stories of how Twitter, you know, came from, you know, that to being Twitter, funnily enough, from audio to Twitter, now back to audio. But, you know, we've heard all these, you know, successful pivot stories where somebody really chooses to go down a very different path with one's product. And others will tell you how it was a process of just keeping steady with one's product vision and to just incrementally iterate on the product. And I think founders often are having to make that decision. And I wonder if you've had situations in the past and how you went about it. Was there a mental framework? Do you speak to friends? Do you call Naval Ravikant? Like, how do you, you know, go about that decision?
It's a great question. And I think it hinges on two factors, which is necessity and possibility. Necessity means if there's no product market fit, you don't have a choice but to do something else. Otherwise, you're going to find out that it's not going to work very soon and we wouldn't be having this conversation. So some product changes are driven out of necessity. And when you see a drastic shift, that usually means they don't even have time to iterate a little bit and add on bells and whistle, and it really just not working. And yet they have the capital or the ability to try something else, perhaps in a related field.
Yeah.
The possibility is when even if it's not truly necessary and that you know, but it's trying, you know, it's a difficult, a slow process, and you have this moment when you see things in a different lens as a team, and you're like, whoa, we're the only team that has this knowledge and no one else is doing this, and all it takes us is like what, 5 months to ship this. Well, why are we doing that? And you switch. That is, I think, far less common. And that usually also means that at the beginning, they didn't have that deep conviction in the first product to begin with. But definitely there have been stories like that that work out. I think most of the time is due to the necessity of the lack of product market fit that leads someone and the ability and the availability of resources or the data point to either iterate, meaning minor changes, or to pivot, which is a drastically different product to roll out.
Thanks, Kendrick. Then my final question, then I'll let you go, is just, you know, around like, how do you then for yourself, for your company, for your work, for your, you know, kind of balanced life, like what works for you in making that journey, you know, fun, making you happy along that journey? You know, what do you focus on? Do you have special routines in the day that, you know, you stick to, that just because you come across, you know, as really kind of balanced, like somebody in a very high growth, stage of its company development, it seems to be you're doing something right in terms of balancing your energy.
Thank you very much, Niko. Most people who know me probably will use many terms to describe me, but balance is not such word. But nor am I aspiring to be a balanced human being. I aspire to be a happy human being and a maximally happy human being, whatever the up and down. And I think the answer for that is that knowing when to take a step back, or doing so as frequently throughout the day as possible, to not focus on just one thing that you need to get done and just kind of like take it all in, the appreciation for the environment that you're in. I'm sitting in Midtown Manhattan right now, and it's sunny and it's warm and in a very comfortable room. And if I have team members around, I'm alone on this floor, then just pay attention to them as human beings rather than like, oh, the person owe me this draft and where is it? Like task-oriented approach has its moment when you need to get a task done, but stop playing that narrative when you clearly are not in that very environment. So turning on the ability to be more present and to be more aware in any setting, I think is something that is a work in progress. I hope that I'm better today than I was last month, but obviously will always be a work in progress. But I think for me anyway, is the one thing that I know how to be happier today than I was yesterday. And ultimately that is the only goal. It's not about wealth. It's not about power, about accomplishment. It's about living a happy existence.
Beautifully said, Kendrick. Thank you so much. Good luck with your path forward.
Thank you so much, Niko. Really, really appreciate you and hope to get to host you at our office sometime soon.